Sometimes even the best-intentioned government regulations can do more harm than good. But then again, cutting back on regulation can also do real mischief.
We did the right thing. That was a very important thing to get rid of. And it was also a waste. I mean, number one, it was a bad group of people running it.
If the CFPB is not there examining these giant banks to make sure they are following the laws on not cheating consumers, who is doing that job?
I can say no other federal regulator.
So which is it? Is government regulation holding the U.S. economy back? Or is it an important foundation for much of the economic benefits we've reaped? And if it can be both, how can we tell the difference? Jeff Miron is Director of Undergraduate Economics at Harvard and the Director of Economic Studies at the Cato Institute.
I don't think there is a definitive study on productivity and regulation. There are many studies of individual industries, of specific time periods, of special cases, but those are all relatively small pieces of information. Finding an overall clear assessment is pretty hard. I think many people would point to key environmental regulation in the United States, the Clean Air and Water Acts, as having been quite successful. But even those are not without some degree of controversy. One certainly finds that as a result of those acts, which were passed in the early 1970s, air got cleaner, water got cleaner. But if you then go the next step and say, were those improvements worth the extra cost? Because, of course, putting restrictions on what firms do and what cars can do raises the cost. And there the assessment is still probably beneficial overall, but not so obviously, not so dramatically. So even for one of the relatively clear successes, I'd say there's still some room for reasonable people to disagree about how effective they were.
Miron has harsher criticism of food and drug regulation, where there has been mission creep, delays, and political and legal tangles.
So the very first major attempt, federal attempt, to deal with dangers of drugs and food was called the Pure Food and Drug Act of 1903. And it did something very mild. It said that medicines and food substances had to include a list of the ingredients on a label on the outside of the package. That's pretty innocuous. Even if you're a hardcore libertarian, it'd be hard to get too exercised about that. But that notion that the government was going to protect people from dangerous products evolved into creating the Food and Drug Administration in 1938, which then had the power to keep things from being on the market at all. That's a much higher bar. Now we have the current system, which involves years of delay, sometimes billions of dollars in testing before things can go on the market, and that probably prevents some bad drugs from ending up on the market, but also delays all of the good drugs from getting on the market. The goal of the Food and Drug Administration is to prevent medicines from entering the market that might have unusual side effects that weren't discovered when the drug was being created, that might not work nearly as effectively as claimed, and things like that. So just protect people, to improve people's health. And yet the process of requiring all the trials, and checks and balances before a drug is released to be used mean that people who are suffering from the condition for which the drug is supposed to be useful face delay. They may die before they ever get a chance to use the drug. I think a lot of economists would say the evidence on the FDA is not very strong, that it may well be doing all sorts of damage by preventing good drugs from getting on the market earlier. And then there's the scope, as with other kinds of regulation, for completely unpredictable unintended consequences that are very different than what people were thinking about when they created the system.
One of the first agencies targeted by the new Trump administration is the Consumer Financial Protection Bureau, a brainchild of Democratic Senator Elizabeth Warren of Massachusetts in the wake of the great financial crisis. Professor Miron sees it as a typical example of regulation coming after the fact with unintended consequences. Catherine Judge specializes in regulatory architecture and banking at Columbia Law School.
The regulatory structure when it comes to financial regulation is an absolute mess. I don't think anybody would disagree with that. We have the CFTC and the SEC as two different market regulators. We have three different banking regulators overseeing banks. So I think there's a lot to be said for saying, let's look at the overall regulatory regime and let's come up with a blueprint that significantly simplifies that regime. We've had a bunch of executive reports, the Volcker report that really tried to say, here's how we can have a more rational and more systematic regulatory regime That's not what we're seeing right now, but there's a lot to be said for moving in that direction.
We have a new Trump administration, and it is dedicated, among other things, to deregulation. One of the first places it's focused is the CFPB. Tell us about whether they have a point that maybe the government went too far in regulating the banks in the CFPB.
I mean, there's some really interesting questions there. So one of the key things to note about the CFPB is that a lot of what it was trying to do was just level the playing field between banks and non-banks. So banks long had obligations to engage in fair lending and to provide truth in connection with their lending activities. And a lot of what the CFPB did said, we have this really robust system of oversight and enforcement for banks, but we have all these non-banks. Let's make sure we have a more even playing field. And then let's create a separate regulator. So that way they have to kind of all do these things together. But one of the important things to note is it didn't create new law. What it really did was just change the supervisory mechanism and the enforcement mechanism around existing laws. And so there's a lot to be said for questioning kind of what is the optimal level of regulation, what is the optimal level of enforcement, but then you actually have to get the substantive law rather than this kind of structure through which it's actually enforced.
There have been consumer protection laws in the states for many, many years. If the CFPB were to go away, could the state step in a federal system and do some of what we need the CFPB to do?
So the states are certainly going to step in. They can play a very important role in this domain. They're not a perfect substitute, and actually it makes it very difficult for regulated entities because suddenly you're having to look at a lot of different states. So one of the things that's really important to note if you're a regulated entity is right now you might be really frustrated with the underlying rules, and you might look at the CFPB as a face of the body that's implementing those rules. But you're not going to get out of any of those rules or legal obligations. You're not going to be able to avoid the possibility of enforcement. It's just going to come from a different source.
Talking about regulating the banks, and the non-banks for that matter, right now, beyond the CFPB, you are an expert in this area. Are there places that we could make sensible reforms? You said that the system overall is a mess.
There's a lot of ways we could make very, very sensible reforms. And I think we could make sensible reforms in terms of structure. There's also a lot of sensible reforms that we could make in terms of the nature of the actual regulatory burdens. We have a tendency with both structures and burdens to be additive, just layer a bunch of things on top of each other and not think holistically about how they all fit together. So I think that there's a very welcome place to try to rationalize the structure of financial regulation, reduce the number of financial regulators we have.
Anyone who's ever been regulated doesn't find it a pleasant experience necessarily. At the same time, the claim is that overregulation is holding back the U.S. economy, that we are less competitive, we have less productivity. Is there any basis for that in the research and the studies?
I mean, there are certainly some areas where you have to be worried about the level of regulation, but it's also important to realize that regulation is very often what promotes innovation, what promotes credibility, and what promotes trust. So if you think about a body like the SEC, for example, they play a really critical role helping to promote capital formation.
You mentioned two things, trust and certainty. What are the risks of just confusion and uncertainty actually holding back the economy?
It's one of the really big risks right now. So I think a lot of the story that we're hearing are the ways that regulatory burdens have really limited economic activity. So if we reduce those burdens, we're going to get more economic activity. But what we've seen so far doesn't actually change regulatory burdens. There's a lot of ways you can do it. If you're an agency and you have rules in place, you can go through a rulemaking process to change those rules, to reduce the burdens. You can go to Congress, have them change the rules. Right now, a lot of what they've done is to gut the capacity to enforce the existing rules, but that too can change really quickly.
In your mind, what's a good example of where regulation really worked and was successful?
I think it's worked in a whole variety of areas. I mean, I think overall the banking system is much healthier and more stable as a result of regulation than before we had the regulatory system that we do. It's far from perfect, and there's room for like ongoing improvement. But before we had the Federal Reserve and the other banking regulators and the system that we have, the United States had far more frequent banking crises than a lot of our other peers that had central banks. And so we started to say, like, look, we actually need a central bank. If the central bank is going to help provide liquidity and provide support, if the FDIC is going to provide deposit insurance, we also need regulation. And it's an overall system that has broken multiple times, but most people still have faith that if they put money in the bank, they can get it out. And so I think we want to protect that trust and protect the functioning of the economy where it works well, and then try to figure out how do we do that.
What's an example in your mind of where regulation really went wrong?
That's a really good question. I was going to say, because there's so many, but oftentimes they're not in finance. I mean, I think oftentimes where regulation really goes wrong in finance is when it creates different burdens on the same activity across different domains. So one of the things that we've really found often is if you regulate really aggressively in one area and all the activity migrates elsewhere, it's not going to work well.
But as Bank of America's Brian Moynihan told David Rubenstein, it's not really about how much regulation, but about making sure it's the right kind.
So at the end of the day, it's about getting these regulations right. And I think it opens a dialogue about how to get these regulations correct.